I'm delighted to have CEO Brett Richards with us today to tell us about the 4 million ounce feasibility level Dugbe project in Liberia, West Africa. Brett joined the company late last year and to lead the Pasofino to acquire 100% interest in the project, reconstitute the board, and position the company to fast track the development of this feasibility level project. I think it's going to be an action-packed time for investors going forward. My name is Ron Stewart. I'm a research analyst at Red Cloud. I'll be your host this afternoon. I've known Brett for a number of years. We worked together years ago building the foundation to what's now Kinross Gold. We had a good time together. During today's webinar, we invite you to ask questions at any time. To do that, simply type them into the chat box that you see on the right-hand side of your screen, and we'll get to them at the end of the presentation. Today's webinar, we'd like to remind you that you're going to hear some forward-looking statements from the company. We direct your attention to their slide 2, the forward-looking statement on the slide 2 of their investor deck, which you can find at www.pasofinogold.com. I'd also like to point out that the webinar today is for information purposes only and is not an invitation or recommendation from Red Cloud to buy or sell securities. Any participant on the line should do their own research and seek their own professional investment advice before considering an investment. Finally, I'd like to add that you can find all of Red Cloud's equity research at www.redcloudsecurities.com. We ask that you note the disclosure statement that accompany all of our research reports. With that, I'm going to pass it over to Brett to hear about Pasofino. Brett?
Yeah, Ron, thanks for the introduction. And yeah, you know what, everyone, thanks for taking the time today to hear the story. Pasofino Gold has been around for a number of years, but the project was held by a company called Hummingbird Resources PLC for many years, and Pasofino took control of it back in 2019. Thanks for the overview of disclosure and forward-looking statements. So we are traded on the Venture Exchange under the ticker symbol VANE. We have about a $65 million market cap today, trading around 50 cents Canadian. So tremendous investment opportunity today, which I'm going to lay out for everyone. Pasofino owns 100% of the Dugbe Gold Project in Liberia. Hummingbird had it in 2008, and we earned into it in 2019 on the basis of delivering a feasibility study. The project has a massive land package in southwestern Liberia, over 2,000 square kilometers of land package, and our footprint has only taken up 8% of it to date. We have a 3.9 million ounce global resource, and we have a definitive feasibility study completed in November of 2022. And it had exceptional project economics then, and I'll show you kind of where things stand today. But from a valuation standpoint, and like everyone's here today, and looking at where the opportunities are in the gold space, the gold junior space, everything's breaking out. We've got gold at 33.50 today, 33.20, and lots of potential for growth in the gold price environment. But gold juniors still hang around that $12, $15, $18, $20 an ounce in the ground inventory. And we are no different. We're trading at 15 bucks an ounce in the ground, yet we have a project that has gone through significant development stages over the last 6 years. Our cap structure, we have 127 million out right now, 147 million shares fully diluted. So very tight cap structure. And Hummingbird, which was taken over by Nyoko Resources in December of last year, they own 50.8% of us. So when I started looking back, and Ron and I were talking earlier about, did you ever think there'd be $2,000 gold, $3,000 gold back when we were at Kinross and it was $250 gold? Even 10 years ago, theoretical valuations of the quality of the resource you have in the ground, be it reserves or M&I or inferred, were were really valued on the quality, not so much just a general blend, paint the brush with quantity. And we were getting $180 an ounce like 10 years ago, 12 years ago for a reserve ounce in the ground. We were getting about $80 for measured indicated, 20 or $30 for inferred. You do that simple math today, and Pasofino, with the quality of its resource we have today, should be north of 500 million of valuation. But that's inventory in the ground, yet we're trading at a $60 million market cap. So significant potential for re-rate simply on the resource quality and obviously the stage of development. We have 6 board of directors, myself and 5 others. 3 are the Hummingbird appointees, which are part of Nyoko now, and myself and 2 others who have been historic Pasofino directors. And we have an agreement with our major shareholder whereby they have committed to fund their portion of the capital required to take this through to a update to our feasibility study for the next 18 months. We have a standstill agreement for 18 months, and we have a strategic alignment as to what we want to do with this company. And I'll speak more to that a little later. But we have a company that is well oiled for future success and very, very short-term success. So I ask people, the retail market, specifically institutions to a lesser degree, but why are we here? We're here because as an investor, of which I'm a large investor in this company. My family office has exposure to Pasofino, but we want gold exposure. We want to hedge against inflation, and we want those big, chunky, risk-adjusted returns, and something that can balance off everything else that's been flying or been falling, and whether that's tech or the big 7. And I want everything. I want blue sky portfolio upside. So I want it all. And that's why, I talk to retail investors, they want it all. So I'm going to show you how and why I think Pasofino can deliver that. I'm not here to pontificate about where the gold price is going to go. You can read, these are all real headlines about $4,000 gold, next year at this time or sooner. And, certainly those who think gold's going to go higher than that. So we are in probably the best bull run we've had in 70 years as far as gold price goes. And we're just seeing this continued disconnect of gold equities from the juniors all the way to the mid-tier developers. But now we're starting to see traction in the late-stage developers, those getting into completing feasibility studies, getting into project construction. We're starting to see their re-rate multiple times and valuation increases in those types of companies. So just to give you kind of an overview, we had a feasibility study completed by DRA Global in June of 2022. And you can find that on CEDAR. It's been out there for some time. But Liberia, where we are in Liberia, we're only 76 kilometers away from a port. And we have a corridor of access 76 kilometers from that port to our mine site. So as far as location goes, logistics go, it's really set up for project construction success and project operational success. I look at certain things, and we've looked at people, we've looked at size and scale, and we're going to look at the size and scale in a minute. I look at these things, but access to infrastructure is equally as important. And I've worked on projects that have absolutely no infrastructure, or those up in the Arctic. They're really, really difficult to get through construction and maintain production. We are in a really, really strong area as far as jurisdiction goes, but also location to logistics. We have a mineral development agreement, and for those of you not familiar with that, that is a law in Liberia. There is a law created, which is a contractual agreement between the government and Pasofino's subsidiaries that lasts and stands for 25 years. It gives the economic framework of how we work with the government, whether that be our tax framework, whether that be our duty framework, whether it be fuel surcharges. and also our community obligations. In exchange for that, we get 25 years, much like a mining convention contained within the mining code. As I said, we have globally, 3.9 million ounces. Get in trouble when you say those aggregate numbers. It's really 3.3 million of measured and indicated, of which 2.7 of that goes into the project as a reserve. And we have, and it's around 1.3, 1.35 grams per ton. And then we have, 600,000 ounces of inferred material. So, this is a project with size. This is a project with potential for scale. And this is going to get into its next stages, which is going to be project financing and project construction in about 8 months. As far as our permitting goes, we've been working on permitting for the last 5 years, and our ESIA, Environmental Social Impact Assessment, and our RAP, our Resettlement Action Plan, are ready to be submitted to the Liberian EPA in about 1 month's time. So we're well advanced on our permitting, and we have been socializing our permitting with the EPA in Liberia for the last year. But one of the things I can't emphasize enough, because I built a mine in Burkina, I built a mine in Sierra Leone, I built a mine in Mali, and I built a mine in Congo. But the difference with Liberia being in West Africa is it's very unique. It's almost a bit like a unicorn. It has the largest U.S. embassy in West Africa, the second largest in Africa, has tremendous long-standing history with America. About 8% of the population carry U.S. passports, and about 20% of the population travels to America, every year on vacation and have family there. So it's a bit of a unique situation. It's English speaking. They trade in US dollars as well as a local currency, but majority of trade is in US dollars. So Liberia as an investment case is not like Burkina or not like Mali or not like Niger right now, who have some geopolitical instability. They have, they've had military coups, they've had dictatorships rise up. This has been a stable democracy for over 10 years now. So this is a place that I think is very doable from building a mine and operating a mine standpoint. Liberia also only have around 10 Class A mining licenses, whereas you look at Mali that have over 100, Burkina have close to 100, Cote d'Ivoire have close to 100, Ghana have over 200. This is a very immature mining jurisdiction with a tremendous amount of potential. As I said, our mineral development agreement with the government, which was passed in 2019, the government has a 10% free carry interest, 3% royalty, and we have the framework for all of our government obligations and our community obligations laid out for us. And it hasn't changed, can't change, because it is a law in Liberia. So back when we did the feasibility study in 2022, the project showed a capex of 435 million. And the post-tax NPV5 on the project was around 760 million US, using a $2,100 gold price. It was sensitized to 2,100. I picked that because when we did this, 2,100 seemed to be the consensus back 6 or 8 months ago. It also had a 36% IRR. And I'll give you the sensitivities on a chart in a bit, because as gold price starts to go up, as you start to use a different gold price assumption and in a rising gold price environment, the economics and the economic outputs from this project really start to power up quickly. In addition, we have strong potential to grow the reserve near mine site. And we have, our ore body is about 94% sulfide, 6% oxides, which illustrates hard rock, which illustrates, certainly crush grind circuit, almost mandatory, or flotation. But we have a lot of near mine site oxide deposits that we need to further explore. We need to find some discoveries near where we are. We've tested them, and we have 5 more targets to test, so that the satellite deposit strategy might be one that we embark on. But we'll just talk about what we know. But again, blue sky upside is pretty strong. And what we're doing to the 2022 feasibility study, the first thing we're doing is a gap analysis. I need to identify where the gaps are in it, because let's face it, feasibility studies come in like quality anywhere from 1 to 10. And if you're at a 5, probably doesn't pass the sniff test for a bank to lend. And we need to have a 9 or a 10 out of 10 on the quality of our feasibility study. And we recognize this going into it. I've only been with the company for about 7 months, and it was one of the first things I saw was that we probably need to do some work to this before we can actually take this to a bankable standard and get lending against it. So we're going to be looking at certainly some minor drill programs to validate and verify the resource. We're going to look at power alternatives, some trade-off studies on that, and also some metallurgical test work to look at various process flow sheet options. So, we will, one of the first things you're going to be doing is updating the resource model. The pits were constrained at $1,600 back in 2022, which was appropriate then. It's just not appropriate now given this gold price environment. And whittle shells were run at $1,700. Again, we certainly can use a higher gold price assumption. I fully don't expect, given the orientation of the ore body, I don't expect we're going to have big wins on resource size. We may bring in some small non-material ounces into the pit shell, but it will resequence things a little differently with a higher gold price. We will do a trade-off study. The original feasibility study used 83% as far as recoveries go based on the test work they did. And I just don't think it's representative of the population. I think we can get that much higher. And we can also look at trade-off of, what does flotation do to the flow sheet versus gravity crushed grind CIL. So we'll be doing some verification drilling, some grade control patterns over the pits just to make sure that reconciliation of the resource model is at a high percentage. And then we'll be doing some variability testing, some geotechnical testing for ARD, comminution testing, and leach tests, etc. What we want to do is we want to have the cake fully baked here before we go for project financing. We will also look to do a power study because the previous feasibility study used liquefied natural gas, and there simply isn't any infrastructure in Liberia to support it. We will be looking at conventional heavy fuel oil and solar, or diesel and solar, with a potential to move to bio and or a portion of it to bio or a portion of it to hydro, maybe in years 5 or 6 later on, in an effort to kind of balance out our carbon footprint. And one of the most important things is we will rerun the CapEx and OpEx, or all-in sustaining, to current levels. So there's a lot of costing that has to be done in the feasibility study, and we'll get there. We engaged MineScope out of Perth, Australia, to do the gap analysis, and we'll get the results in a couple of weeks, and we'll present that to the market. Might be a little sooner than that, but all things indicated, no surprises in what we're seeing, no fatal flaws, and quite frankly, a little bit of work to do, probably kind of 8 to 10 months worth of work to do before we can get this to the finish line. So once we get there, we will be doing an updated resource model in the interim, and we'll be doing an updated 43-101 at the end of it. Again, we will be. There's a number of obligations we have within our mineral development agreement to bring it into full compliance before we apply for a Class A mining license, submitting all permitting by the end of this year, or certainly into Q1 of next year, so that we have everything in good state for our final investment decision once we have secured project financing. So we would like construction activities to start. I'd like them to start in September this year, but probably going to start somewhere around September of next year. This is just kind of the breakdown of the 2 pits that we have. This is the resource inventory, the MRE, of both Tuzon and Dugbe F. Again, not talking about a high-grade open pit situation here. This is 1.3 grams, probably median for West Africa. There's certainly those with higher grade, and there's certainly those with lower grade. But given the nature of our ore body, this is highly economic for extraction. This basically gives you an idea where we are, and the color tones here really indicate the Birimian volcanics and the Birimian greenstone in West Africa, all the way from Burkina in the northeast and Mali and Guinea across the top down to Sierra Leone and Liberia, Cote d'Ivoire, and into Ghana. We are in the kind of southern heart of the Birimian greenstone belt, and there are a lot of operating mines with major discoveries and major production profiles in and around where we are. And quite frankly, I can see one of the reasons for the optimism in resource potential and resource growth potential is simply because this is how Ity started. This is how Yaouré started. This is how Bonikro started. Start with 1 million, move it to 3, and then go from there. And a couple of these, and Ity is 7 million ounces today. So there's a lot of scale here for potential growth outside of our project. Just a high-level overview of kind of the CapEx, 435 million from 2022. We're not expecting that to change materially. It's going to probably change a little bit, but with the power study we're going to do, I would prefer to have outsourced power, bring in a company that generates power, that this is what they do for a living, and we'll buy the power from them at a small premium. It will save probably $30 million on our CapEx and probably increase our OPEX all in sustaining by $100, $120 an ounce. And you can see here, there is work to be done on the port. Says here about $8 million. We're comfortable with that number. The access road, 36 million. Also comfortable with that. Just the road and the port is 10% of the overall CapEx. So there's a lot of work to do, and there's a lot of pre-construction activities we can get working on between now and then. Capital being available, but this is kind of the overall situation. From an operating cost standpoint, again, I'm not going to wave my arms and say we're the lowest quartile of all-in sustaining costs. $1,000 done in 2022. I expect that to go to $1,200, maybe $1,250, given normal inflation and given the power component that we'll put into AISC. But still, that is a good place to be from an operating cost standpoint. And again, are we median or just under median in West Africa? I would think we are. Haven't done the analysis, but there are those operating at 1,500 and there are those operating at 750. So we're quite in or around the middle. And our total OPEX, as far as dollars per ton mill, mining, processing, G&A, are all kind of bulk standard, probably right around the median of our peer groups. The strategy is to have 2 open pits, Tuzon and Dugbe F. Just gives you the mechanics of what the strategy is, the mining engineering side of things. 5 million ton per year operation, pretty standardized 90-ton trucks, 100-ton excavators, plus 200 for waste, and pretty competent rock. We're going to probably run 57 degrees slopes, so we've got pretty stable host rock. From a process flow sheet, and this is what I mentioned earlier. Right now, it's a conventional gravity crush grind CIL. It's very standard, bulk standard, the simplest process you can get. This is how they thought of the feasibility study back then. They were conscious of CapEx. They were conscious of, obviously, the recoveries that they would get from it not being ideal or optimum. And I think now we're in a situation where adding 5% recoveries to this project is pretty material, and it offsets any necessary CapEx to do it. It would offset it. But we are looking at flotation in a trade-off study because it will use considerably less power than crushing grinding, but it will also increase recoveries closer to that 90%. And that is subjective. That is subject to the met test work we're going to be doing over the next 6 months. So as I said, the current process goes down to an ultra-fine grind, 53 microns, and then a traditional circuit. This is something I think is where the blue sky comes into play, but also I don't think back in 2022, they spent a lot of time on the optics of this. This is just ore and waste movement. So you've got a very lumpy mine plan here. It's a 14-year mine plan, but it's very lumpy. From year 1 up to kind of year 6, it gradually increases up to 50 million tons a year, and then slowly works its way down. On average, this is a production profile that looks like this. It is also lumpy, but in the yellow lines here, our goal is to maintain that 200,000 ounces per year. And I'll tell you why, is because the first 5 years of this mine in operation, they achieved 200,000 on average per year. But as you can see, it tails off quite a bit as you get deeper into the pits and you get deeper into lower grade material. Hence the strategy to have resource development drilling from day one. I'm talking a $15, $20 million a year program, maybe 20,000, 25,000 meters a year, to go out and look for satellite deposits to support a satellite operation, have multiple pits shallower than just running 2 straight pits. So our goal is to maintain 200,000 ounces per annum, and we got 5 years to do it. So if we're able to do that, and we're able to look at, if we keep the conventional circuit that we have in the existing feasibility study, and we allow for flotation, it may well allow us to increase our production in a phase 2 construction, maybe in year 3, 4, whereby we could ramp up production. And again, based on the fact that we will be successful in our exploration efforts and in our resource efforts, in order to take this production profile a little bit higher. But maintaining 200,000 ounces a year, let's call it 225 on average, is a pretty decent when it comes to our peers in West Africa. We have spent a lot of time, and I just brushed on it early, about our ESIA efforts and our resettlement efforts. We have a fully 95% complete ESIA. We have baseline work that needs to be added to it for the last couple of months, and we'll be in a position to be able to submit that to the EPA for approval. But it contains, comprehensive studies in biodiversity, ecosystem management, and quite a area on carbon neutrality. We want to be carbon net positive because we think that is, it's responsible, it's sustainable, and quite frankly, in our circles, we also call it bankable. And there will be, additional geochemistry work and work that we need to do from our tailings design in order to support the submission of the ESIA. And that'll take us a couple of months. But this is the real chart that I want to draw to everyone's attention. If you don't look at any other slide here, this is the most important one. This is the gold price sensitivity analysis from the previous feasibility study, and this is on CDAR. I'm not making anything up here. The feasibility study was run on $1,700 pit shells, and as you can see, the capex was $435. The all-in sustaining is $1,005, and the pre and post-tax NPVs are also listed. I like to use post-tax NPV because that's real world. It's a lower number, but that's the reality at the end of the day. Post-tax NPV here of $524 million. So on a ratio to capex is about 1.15, 1.2 times capex at $1,700 gold. It's got an IRR of 23.6% and a payback of just over 3 years. And that's using the 5 million tons. We've sensitized it back in that feasibility study. We looked at 4 million tons. We looked at 3 million tons. We looked at 7 million tons. We looked at what the ideal throughput is for the size of this resource, and we landed at 5 million tons, and we do not expect that will change. So the production profile is, on average, is 171,000 ounces per year for 14 years. But you heard me say earlier that the first 5 years is over 200,000 ounces, and that's where we want to focus our efforts on resource development drilling. The total ounces recovered are just under 2.3 million, and it's got just over 4-to-1 strip ratio. So it's very attractive from a kind of a mining and an operating standpoint. And it has a life of mine grade of 1.3. When you start to look at this gearing up towards 25, 27, 29, 31, and we'll probably use 2,700 as our constraint gold price assumption when we remodel. You can really see how the top line, the revenue line, and we're not changing anything else here, just the top line of this really impacts this project. It goes to a $1.67 billion post-tax NPV on a $435 million capex, over almost 4 times ratio of post-tax NPV to capex. Tremendously economic. I beg you to find a handful of projects in Africa at this stage of development today that are as robust. Over 54% post-tax IRR. So this is really, really staggering. And I'll show you in a second kind of what it really does look like at today's numbers, because it's pretty exceptional. But when I talked earlier about resource valuation on inventory in the ground being 180 and 80, depending on the quality of the resource, that's really no longer in play. In my view, we haven't achieved it, but we're going to jump past that almost fractally to look at re-rating this company to a function of trading on multiples of free cash flow. And at $3,300 gold today, and I'll use $1,300 as a all-in sustaining cost, and 200,000 ounces, this project can generate $400 million of free cash flow. So it is extremely robust in today's gold price environment. And as you can imagine, the sooner we get this into production, the sooner we can realize all of this. And when I talk to my major shareholder, who is also, their parent company is a bank, they say, well, Brett, we want to use this as a vehicle to distribute. And I go, guys, I've run multiple operation gold mining companies before. It comes with risk. I'm an investor. My family office is an investor in this. I want to make money. I want my shareholders to make money. Our strategy is to get this into production, get the debt paid off, and distribute. And so you can imagine what this looks like as a dividend yielding company in 4 or 5 years' time. When the slate is clear, the mine is built, the debt is paid off, this can very easily be one of the highest performing dividend yielding stocks in our space. So I don't want to build a big gold company, don't want to build a Kinross or a Barrick or a Newmont, or I want to build a company that makes money. So when I come back to you guys, I say, hey, why are you here? You're here to make money. Because on today's market cap, now we're up to 70 million. I guess we traded it up today. But when the producers, the early stage producers, traded 2 or 3 times, some a little higher, of free cash flow, and the mature producers traded 5, 6 times. And in today's world, that would value Pasofino at $2 billion. And when I look at where we are at $70 million to a $2 billion potential, and those are also currency diverse. We've got Canadian dollar valuation to US dollar valuation. Currency adjusted, that's 50 times money. If we get this half right, it's 25 times money. If we get it half right again, it's 12 times money. And we all look for 10 baggers. So this is all about execution. There's no discovery risk. There's no, in my view, there's no geopolitical risk. There's no logistical risk. There's no potential risk of, there being something wrong with the ore body, something wrong with the metallurgy. All these things have been tested, and we're going to actually just make them better. So it's a very, very compelling story when we talk about the potential for earning and the potential for share price appreciation over the next 12, 18, 24, 36 months. And these are the activities we're going to be doing so that we get all these studies done over the next 8 to 10 months. We get a tech report out. We get our licenses applied for, of which they have 90 days to respond. But we've been socializing all of this work we do with the Ministry of Mines and the EPA. So no surprises. They know what we're working with. And then we get this into construction and commissioning. and we're talking 28 to 30 months of construction and 8 months of commissioning. So we can be in first gold, probably as far as late stage developers go, probably one of the latest stage in our space. So that's where that's the story, and I really appreciate everyone hanging around to hear the end of it, and happy to take some questions, Ron.
Brett, that was a terrific job, and certainly presents a pretty compelling case. I don't really know whether or not you've done such a good job that nobody's asked any questions or what, but I have a couple of questions. I'm one of the few people that have actually been to Liberia and kind of know where you are, but maybe for the benefit of our listeners, you can explain kind of what the local scene is like around the project. Is it an agricultural base economy, or what kind of population is around there? Now, I've been there, so I kind of know, but I think it might be helpful to understand sort of the population density in and around your project.
Yeah, no problem. So we're in Sino County, and Sino County have maybe 5,000 or 6,000 people. There's only 8 million people in Liberia total.
Right.
And the population along our 76-kilometer road in the various counties, we have 4 impacted host communities in Sino County: River G, Grand Cru, and Maryland. As you'll see, they're all kind of U.S. names at the end of the day. But, the population is pretty sparse. Now, yes, we have artisanal mining on top of our pits right now. There's a few hundred people. And we go out and talk to them every day. And I've been out to talk to them. And, they are actually looking forward to the transition, because our obligation under our resettlement action plan is to not only compensate them for what they're doing now, because they will be displaced, but we also have an obligation to find them work. And that will come with skills training. That will come with actually increasing their livelihood in addition to rebuilding a home. So it's all part of our CapEx. It's all part of our resettlement action plan. And I would say, there's hundreds on both pits. The communities are so anxious for us to get going on this. And now I see a couple of questions come through. Johan, you asked here, why did the project not move forward once the feasibility study was published in 2022? And these two things kind of dovetail. So Hummingbird, the parent company, were focused on Dugbe. And Dugbe, the community and the government, they thought they were going to. They thought in 2019 they were going to move forward with building it. And then they got access to Yanfalila, which was a project in Mali, which they built for 80 million. And then they got it up into production, and then they focused back on Dugbe. And then they had access to Carusa, which was from Cardinal. They got Carusa in Guinea, and they built it for 180 million. So the CapEx for them was manageable on those two projects, and they just kept pushing Dugbe to the side. Now, the communities, to your point, Ron, the communities obviously did not like this, and they when I started here 7 months ago, it was one of the first things I wanted to address, because I've been brought in to build a mine. I'm not brought in here to kick the ball down the field some more and wait for happier days. We are ready to build a mine. As soon as we get a feasibility study done, as soon as we get it updated, we will be in a space to raise our project financing and get this started. But it wasn't done from 2022 because Hummingbird ran into financial distress on their Carusa asset, and they simply didn't have the capital to do anything. So in 2019, they partnered with Pasofino, and Pasofino earned in, and they delivered the feasibility study. And then the project just sat under Hummingbird's tenor. It just sat idle, and Hummingbird didn't have the funding to put into it, which was unfortunate. But that's why it sat idle for 3 years. I'll tell you, Pasofino didn't even have a CEO for those 3 years. The former CEO, Ian Stalker, who lots of guys know, and I got a lot of time for Ian, and we've worked together on a few things. Ian he couldn't raise capital, so he went off and did other things, and I don't blame him, because Hummingbird wanted to keep control, and they wanted to try and fund this themselves. So it just didn't happen. And another question here: do commercial banks have risk appetite for project financing in Liberia, or will you depend on development banks or similar institutions? I'm just going to speak from my experience, Johan. Multilaterals and the IFC, African Development Banks, and a lot of those multilaterals have a lot of capital to spend. The problem is their period of due diligence is about 5 times what I have available for them to do diligence. I need to get this project built. So we probably won't be using IFC, ADBs, African Development Banks. We probably won't be using multilaterals to fund this. We will probably go less conventional, more unconventional. I just saw recently that Royal Gold put a lovely stream on Kansanshi, on First Quantum's operation, gave them $1 billion. We will have to look at alternative financing. And yes, I recognize that it will impair those stellar economics I'm talking about. It will impair them slightly, but it will de-risk this project. And again, if a 50 bagger turns out to be a 25 bagger, that's still an extremely good return. What I don't want to do is kill the equity story. And I simply, we have we're in such a good place with our capitalization. I just can't blow out the cap structure to do this. So I have to be very creative. Keep in mind that I have a 50% shareholder who's a bank, and they also do project lending, and they did it to Carusa, Yanfalila, Orzone. They own 19.9% of Orzone in Burkina Faso, and they do other lending, other project lending, and other operational lending to mining companies, mining service companies. So they are our partner. So I fully expect that I'm going to rely on them to participate in this as well. Which company, another question here, which company will be responsible of new DFS? Last one was not satisfied. Yeah, last one was did not satisfy the investors. I think you're 100% right. So Pasofino, Brett is going to be responsible for the feasibility study we're doing now. Was the last one definitive? Yes, it was definitive. But again, as I talk to quality of feasibility studies, they can range from 1 to 10. And I need to be around 9 to 10. I need to do this to a standard that we can pass due diligence on senior lenders, on senior off-balance sheet lenders. So we need to do this to a very, very high standard, and we are going to be doing it to a high standard.
I think as well, Brett, that it's fair to say that Hummingbird really wasn't focused on Dugbe as a project. They were distracted by some other things.
No, I think it's 100% right, Ron. And quite frankly, the market has penalized Pasofino because they probably didn't believe the feasibility study was of a high quality. And but I can tell you that there are no fatal flaws, and we did that assessment very early on. But now it's about making it as strong as we can make it.
I'm not sure that the general market is really even aware of the project being there and the quality of the project to begin with.
No, for sure. And like when Hummingbird had this, and they're listed in London, so let's face it, they don't get to Toronto, Vancouver, New York very often. Never did. But not a criticism of them, but their majority of shareholders were in London. And quite frankly, without a CEO, it's pretty difficult to go through marketing and market this project. And our CFO, Lincoln Greenidge, he did a tremendous job trying to kind of keep the momentum going, but a lot of wind in his sails when you can't get out there and market, and you don't have the capital to do it, and you don't have the capital to advance the project. So another question, what finding is required to finalize the feasibility? How does the company plan to fund this item? I think we've talked about how we plan to fund it. And I don't have a 100% answer to that yet. I think it's going to be a balance of a number of things. I don't want to put any more royalties on this, but are we going to look at other alternative off-balance sheet stuff like a stream? Yeah, we will, because the cost of capital for a stream is probably slightly lower or materially lower than where the cost of capital would be trading at 50 cents today. There's no 70 million market cap. So I think we have to look at that. And we'll be looking at joint ventures. We'll be looking at, bringing in a strategic and all of those things that you do when you're going to kind of get to the level we're going to be at. And yeah, I think that may well be something that we look towards as well. So yeah, don't have a final answer on that. All I know is that we're thinking about how we can possibly do it.
I think that pretty much wraps us up for the afternoon, though, Brett. I really appreciate your participating in this and whatnot. Another question just popped in. Let's see.
Any dilution is on the table or not? Well, there's obviously going to be a bit of dilution as we raise to get us to the finish line. CapEx looks like so low. Any plan to update it? And the answer, if you maybe missed the first part of the presentation, but our gap analysis has identified that yes, we will be going through geology, mining, metallurgy, and processing, infrastructure, tailings design, water management, ESIA. We're going through every discipline in the technical report to look as to how we need to update it. Let's face it, during the feasibility was done post-COVID. Oil was $125 a barrel. It's 70 today, 75 today. Steel prices were 40% higher at post-COVID than they are today. So there's going to be some gains, but there's also going to be some inflationary stuff. So yes, to answer your question in a long way, we will be updating the CapEx and OpEx, all in sustaining costs.
And when do we expect to see you have the feasibility wrapped up? Just recap that one.
Yeah, so the gap analysis, the results of the gap analysis will be out in the next 2 weeks. I'm hoping by the end of August we'll have some sort of indication to the market, maybe the first week of September. And then probably about 8 to 10 months from that point in time, we'll be through all the work activities, the resource model update, all the drilling we need to support it, all the met test work will be done, all the engineering, and then we'll start into front-end engineering and design. It'll all be done in kind of circa that 8 to 10 month period. And in parallel, at the near end of that, we'll start having project financing discussions. So I think we're sitting this time next year, 12 months out from today, and we are mobilizing people, processes, and equipment to start a construction project.
Well, I think we will all be following the project with interest. Brett, I really appreciate your time this afternoon. Thank you very much to all our listeners and the people who have participated in the call today. This looks like it's going to be an exciting time for you going forward.
Yeah, thanks, Ron. And thanks, everyone, for taking the time today. I'm accessible. You can reach me anytime. Happy to give updates to the market.